If you're trading currencies and you do not have a tab open with the US 10-year yield, you're missing on a massive leading indicator for your trading. Now, to show you why, I've simplified fundamental analysis with the bond market into this 4-row cheat sheet. If you stick around, I'll explain you how to use it. The cold hard truth that no one wants to tell you because it's too complex to sell courses is that currency prices do not move because of lines on the chart. Currency prices move because of capital flow. Money moves where it's treated best. And the scorecard of that capital flow is not an RSI, it's not the whatever of the block, it's the bond market. Today I'm going to show you the engine room, the thing that actually drives the car. And believe me, by the end of this video, you will look at a price chart and you realize that you've been trading with an eye closed the whole time. Let's get into it. Now let's strip this down. Forget the jargon for a second. Let's talk about yield. Imagine you're an asset manager. You have quite a decent portfolio to manage for your clients. You're not trying to scalp 5 pips on a 1-minute chart. You need to park that cash somewhere that pays you a return, a yield. Now you have two choices. Choice A, you park it in the US Treasury market, and you get 4% interest. Now choice B, you park it into Germany and it gets you 2% interest. Where does the money go? It goes to 4%, obviously. It goes to the US. So to buy those US bonds, you need US dollars. You cannot buy an American bond with euros. Okay, you have to sell the euro, buy dollars, and then buy the bond. That movement moves the euro-USD exchange rate. This is the mechanism. Simplified, but this is the mechanism. Now, hear me closely, because this is where 99% of the videos out there stop. So you're just left with this knowledge that says, okay, if interest rates are higher in currency A and interest rates are lower in currency B, then currency A goes up against currency B. Well, you go trade that and you get absolutely run over because that does not work all the time. It's not true that the currency with the highest interest rate, the highest yield, appreciates against the one with the lowest yield. That's not true. That's not the way it works. In fact, everything so far that I've mentioned to you is extremely basic stuff. And if you've been around the block already, stick with me, because here, right now, it's where it gets really powerful. This right here, this is the code. This is the cheat sheet. I've simplified institutional global macroeconomics into these 4 rows using the 10-year yield as an indicator. Now, if you can learn and understand this table, believe me, your trading will thank you. So to help you understand it, now I'm going to walk you through these 4 scenarios one by one. We got rising rapidly, rising slowly, falling rapidly. Now we're talking about the 10-year yield here, okay? US 10-year yield. Let's look at the first row. Rising rapidly. What does rapidly actually means? Well, it means the market is freaking out a little bit. It means the Federal Reserve is coming out swinging, maybe inflation printed hard, maybe Powell woke up and choose violence. The point is that the market thinks the Federal Reserve is going to hike rates aggressively. Okay? So yields move up, and they move up aggressively because the Fed is expected to do so. When this happens, money doesn't just buy the dollar, it rushes into it, and it does so against currencies that have usually the lowest yield. I'm gonna explain you this in a second. Now look at this column right here. In this scenario, what do? You long the dollar against the JPY, the euro, and the Swiss franc. You do so because if interest rates in the US are rocketing up, then you want to buy the dollar against currencies that usually move much slower, meaning that they usually keep interest rates low. That's Switzerland, Japan, and Europe. Particularly Switzerland and Japan. They're very reluctant to hike rates. Now, this is what happened exactly in 2022. The Federal Reserve realized that they messed up a little bit on inflation. Things were getting out of control a little bit. And so they started to hike rates aggressively, 75 basis points at a time. Now, these are massive moves, okay? These are really big moves. And for that reason, the US 10-year yield, which right here in this chart, we're looking at the orange line, rocketed higher. Now, obviously, it had a few moments where there were a little bit of doubts, but most of the time, it absolutely rocketed higher. From 1.5% up to 4% in less than 12 months, in about 6 months or so. Now, again, what do you do in this context? You long the dollar against the Japanese yen, euro, Swiss franc. Now we're looking at the Japanese yen, we're looking at USD against the Japanese yen, right here in this chart, in the candlestick charts. And look what happened. It absolutely followed US yields. Why? Because Japan, during this whole time, kept their rates at 0, while the US went the other way. So think about this, the spread, the interest rate differential, the spread between the two interest rates exploded in favor of the dollar. So the yield of the dollar got a lot more attractive than the yield of the yen, because Japan was paying pretty much 0 interest rate and the US dollar was paying first 2%, then 3%, then 4%. The higher the Fed hiked, the more the interest that the dollar was paying, as yields went up to as high as 4%. So USD/JPY went from 115 up to 150 at 3,500 people. Now, this is what macro does when you understand it. Because think about this, if you didn't understand this context in this moment of time, and let's say you were trying to short USD/JPY because, I don't know, it looked like it was stopping here, looked like it was stopping here, whatever, then you got run over because you did not understand that the context was absolutely bullish because interest rates were being hiked and we were in a rising rapidly regime where you only buy the dollar against Japanese yen, euro, and Swiss franc. You do not look to short this. Even if it pulls us a little bit, you do not use this to short. You just use this to buy. Look at row 2. Yields are rising, but slowly. This is the strength, but controlled type of strength in the economy. The market is not scared about inflation, hyperinflation, none of that, which was the rising rapidly regime. In this rising slowly regime, the market is just, content and satisfied that the US economy is strong. GDP is up, labor market is strong, whatever, all the good stuff. In this case, the Fed definitely doesn't hike aggressively. Maybe they don't even hike at all. They just stay with high interest rates, okay? And certainly they're not going to cut either. They're just keeping interest rates high because the economy can handle. Now, yields are up, positive growth expectations, and the Fed keeping rates high but not hiking. Maybe they are hiking very slowly, 25 basis points here and there at one meeting and the other, just definitely not the rising rapidly, okay? Now in this environment, the dollar is still king because this is the US exceptionalism, we call it really US exceptionalism context, where the US economy does well, interest rates are high, and if you think about it, there is no competition. The US is in fact exceptional in that case. High yield, solid economy, you have all you need to park the cash on the dollar, on the US economy, maybe buying US bonds, maybe buying US equities. So this creates an environment that is supportive for the dollar because there's a lot of inflows that go to the US, either by buying bonds, either by buying equities and such. But if you look at what we do here, you don't look to long the dollar just randomly. You look to long it against a currency where the central bank is cutting. So you look for the weakest link, so to speak. You look at the currency where they're doing pretty much the opposite, okay? But the yield is actually being reduced. Because this is where policy divergences work great. This is the environment where policy divergences work great. If the US is holding steady and strong, yields grind up. Again, they're not rising fast, they're not rising rapidly, they're rising slowly. And let's say that instead Canada or the UK is signaling cuts because their economy is weakening and their yields, in fact, are actually flat or just going lower. And that's your target. You pair the dollar against the weakest. Now, early 2024, this was when the Fed was keeping rates high, not cutting. Growth was decent. So if you look at the chart, again, in the orange line, we're looking at the 10-year yield. Yields were grinding higher, we're trending higher, but slowly. We're not looking at the big increase that we've seen in 2022. We're looking at a slow grind up. Now, at the same time, the Swiss National Bank was the first central bank to cut interest rates in this cycle. Everyone hiked interest rates except Japan in 2022, 2023. And in 2024, everyone was looking at who's going to cut first. Well, the Swiss National Bank cut it first. Again, in contrast with the dollar, where the Fed was not cutting rates yet. So this created the perfect environment where US yields were rising slowly. On the other side, we had the Swiss franc in Switzerland. The Swiss National Bank was cutting rates. So what happened? The US Swiss franc went up, okay, following US yields, because there was this divergence between the two. Now we were in this regime. We know that we need to look for the dollar against a currency where the central bank is cutting. In this case, it was Switzerland. Now we flip the script. We go into lower yields. Yields are falling slowly. Why? Why do yields fall? Well, yields fall because inflation is cooling, the economy is weakening, it's not crashing yet. We're going to get to that in a second, but the economy is slowly weakening. Yields down because the Fed expected to cut, but the economy is still holding up well. Again, it's not crashing. It's doing okay. Maybe labor market is softening a little bit, but nothing too concerning. Again, it's critical that you understand that in the falling slowly regime, the economy is not crashing. It's not a recession. It's not a major slowdown. It's just a touch softer data, which allows the Federal Reserve to go a little easier with their monetary policy. They're going to cut rates, they're going to push the stimulus button a little bit, but nothing huge because the economy is still doing well. They don't need to, push for the stimulus as much as possible because they have to lift the economy. No, this is the soft landing scenario, okay? This is the Goldilocks scenario. Now, if we look at the trade that we take in this scenario, it's long the S&P 500, short USD against the Australian dollar, the New Zealand dollar, the Canadian dollar. Now, the reason for this is that if the world, we can say, but particularly the US economy, just sentiment in general is safe, is positive, and at the same time yields are actually dropping, then funds leaves the safety of the dollar, because the dollar is a little bit of a safe haven, and then it goes looking for risk. It goes into the stock market, it goes into risk currencies, what we call high beta currencies like the Australian dollar, the New Zealand dollar. So it goes seeking for risk. That can be crypto as well. So if you see yields drifting lower, falling slowly, not falling rapidly, I'm going to get to this in a second, but falling slowly, I'm going to show you an example soon. You don't buy the dollar, particularly you don't short risk assets. Here is where you want to be long risk. Either a high beta currency, an equity index, Nasdaq, S&P 500, even crypto and Bitcoin here. For instance, look at November and December 2023. Looking at the US 10-year bonds yield, and it was trending lower, not falling rapidly, it was falling slowly. This was when the market was starting to realize that the Fed was done hiking rates. The economy was still doing pretty well. This, in fact, was where the term soft landing started to get pretty popular. The Federal Reserve was getting inflation under control and getting ready to lower rates. What do you do here? You long risk assets such as equities and you short the dollar against the high beta currencies. Now, look at the S&P 500 here. It went vertical while yields were trending lower. Look at Bitcoin, same, up while yields in a regime of lower slowly. Look at the Australian dollar against the US dollar, up again while yields slowly lower. Now the point is that in this regime, you stop buying the dollar, okay, and you go long risk assets. Now, if I can give you a little bit of an insight here that is going to help you quite a bit, is that if we want to be precise In this context, I would say that if you want to be on the safe side, the highest conviction trade between all of these is the S&P 500. In a regime where yields are falling slowly, the Fed is cutting rates, and the economy is still holding up well, you absolutely want to be long the S&P 500, the Nasdaq, maybe even Bitcoin. But the best absolute trade is long the S&P 500. But contextually understand also what should happen in Forex, okay? Where the dollar weakens against high beta currency like the Australian dollar. Just know that if you have to choose between these, choose the S&P 500. Now, another example is August and September 2024. Inflation started to come down a bit. The Fed signaled that a rate cut was coming, and in fact, they cut the rates in September 2024. But was the economy crashing? No. Was the labor market collapsing? No. So the 10-year yield was grinding lower. Now, there was a time actually where this was getting a little concerning, and I'm going to explain you in a second how you can actually trade a regime where yields are actually falling fast. But aside from this short-term move, most of these moves were actually a regime of falling slowly. This is the definition of a soft landing. Cost of money gets cheaper, but the economy is still growing. So where does the money go here? It goes to equities like the S&P 500. It goes to metals as well. It goes to commodities. It goes to anything that can be considered a pro-growth asset. So an asset that does well when things are positive and the economy is okay. And the Fed is actually also supporting too. And finally, ROFO. This is the big one. This is the huge one, okay? Yields are falling, and they're falling rapidly. Maybe it's a recession, maybe it's a pandemic hitting the world, whatever it is, this is where investors are scared. They dump everything to buy bonds for safety. Now, look at the trade. In this case, you short the dollar against the Japanese yen, the euro, and the Swiss franc. The exact opposite of scenario 1, of course. Now, if I want to be precise here too, I wrote the dollar, and it's fine, but the even better trade here is to look for AUD, NZD, shorts against the Japanese yen, the euro, and the Swiss franc. The reason is that in this specific scenario, you want to short currencies that are sensible to risk-off flows and buy safe havens. Because when yields fall this quick, it's always because of a recession, an important macro event that shakes things up, something that creates a risk-off flow. So away from high beta currencies into safe havens. Look at March 2020. US yields crashed from around 2% down to almost 0% in a matter of weeks. This is a massive move, and the market knew that the Federal Reserve was going to cut rates to save the economy. And in fact, they did. So, in this context, in this regime, what happens to the Australian dollar against the Japanese yen? You can see it's pretty much the same exact chart, because this is what it does. It follows yields. When yields are falling rapidly, a high beta currency against a safe haven goes down with yields. The yen is the ultimate safe haven, and the Australian dollar, the New Zealand dollar, the Canadian dollar are high beta currency. They do not do well when things get into recessionary mode, fear, stuff like that. So here's your homework. Screenshot this table, print it out, tape it into your desk, and before you take a swing trade, ask yourself in which regime we're into. Are yields rising rapidly, rising slowly, falling slowly, or falling rapidly? Importantly, also understand whether this context is actually likely to continue or not. That's the whole point in fundamental analysis. You want to understand a bit more that markets move on expectations. Well, I got a lot of videos on that. But so far, the point is to understand these 4 regimes that you need to be aware of, because this tells you exactly what you need to focus on, the type of trade that you need to look for. This table is your map to simplify global market trading.